Welcome back to Cheddar Movers, everyone. Here on the floor of the New York Stock Exchange, tracking a market meltdown on the day. And Goldman Sachs is warning that the U.S. companies will see zero earnings growth this year because of the coronavirus. And Bank of America declaring the global economy is heading for its worst year since the recession. With us now to discuss and break this down further is Ted Oakley, who's the managing partner and founder of Oxbow Advisors. Ted, always a pleasure to get some of your insights here. Let's start with this. Is this the strongest sign yet that the economy and the economic fallout from coronavirus isn't going to just blow over in the near term?
Well, you know, Brad, I wouldn't think the near term. To me, the earliest you could get over all of this, even if you get it under control, because of what you get in place, is mid to late summer. So the idea that you'd be back to business normal April, May, I think is fairly far-fetched.
So do you not then think that maybe these reports are also getting ahead of themselves? I mean, it sounds like you're going to say no to that question, given your timeline. You feel like it's going to go even further down the line. I mean, you know, what's notable is that none of these banks, you know, they don't want to obviously create panic, but nobody seemed concerned until this weekend when these cases jumped around the world, just outside of China. Everybody was like, well, you know, might not get that bad. And I mean, at this point, are we at a point of sort of no return with all of these analysis and the prospect of the next couple of months being any better?
Well, I think, you know, hope what happens in these situations is people extrapolate things that may not come to pass. I agree with you on that. And, you know, they look out into the future. I do think you have to look at what you have, but one of the problems we had is that complacency for the last 2 months, but going into February, was extremely low. Nobody was worried about anything, and valuations were extremely high, so that's probably added to part of the problem here in a way from a market standpoint. But I think what happens with people in general, particularly today in this information world, is it spreads really quickly, and all of a sudden it's almost worse than it really is. And I think that's what you're referring to, but that I would have to agree with that.
We're off the lows and back at the point where we started off the day. Do you think that there are investors out there that would look at today's activity and even around 10:30 a.m. in the back of their head said, maybe I start to put some more money to work into this market, understanding that if we are 10% off of the highs, there's still reason to believe that we'll make up at least part of that ground?
You know, Brad, I think that's correct. One of the problems you get into on corrections is once you get 5 or 6% down, you usually go on. Typically, you'll go on to 12, 15% down or more. And investors have been really set up for the last 10 years to buy the dip, and it's never gone wrong for them yet. So right. I think they have to be careful right here, because this may not be the point they want to completely buy the dip this time. I think we said all along the last 15 months that you should have some liquidity, and we still feel like that now.
Okay, so a lot of fleeing, of course, to cash. We're seeing yields of the 10-year, the 30-year falling to new lows. There's obviously a flight to safety here at this point. I mean, do you agree with Goldman? Do you agree with Bank of America right now that we're going to see some pretty serious pain going forward this year?
Well, you know, Hope, we were ahead of Goldman probably on this, and we expected the numbers to barely come in, barely low single digit at the very best this year, even when we came out in December with that. But it didn't surprise us that they're looking at it now and saying, hey, it would be zero, because we felt like all the GDP numbers, expectations for the year were too high. If you looked at the world economies, it had nothing to do with coronavirus. If you just look at the world economies, it had to eventually affect the U.S. somewhat, and we felt like everybody was too optimistic on the numbers.
All right, well, Ted, we are not clients of yours, but if we were, what does our portfolio look like right now? Where are you?
We're actually in really great shape. I think probably as good as anybody right now, because we run a couple of strategies. But on the income side strategy, we had about a 40% position in treasuries, a half of which was the long-term treasury, which we've had for the past year. And secondly, in the stock accounts, we're about 35% liquid. We'll buy some things when they get cheap enough. And we don't own any energy in those stock accounts, so we're in good shape. We're actually well ahead of the numbers for most things this year, bond market and stock market, but it's because we're defensive, but we've been defensive for the last 4 or 5 months.
You had a critical op-ed of the Fed in the Wall Street Journal from Kevin Warsh, who's one of the former members of the Federal Reserve, and he said that they should not be waiting to respond to the coronavirus. What do you anticipate is the action that the Fed will take, as they have had to have this on their radar for several weeks now? And Fed Chair Jerome Powell has commented and addressed the concerns around the coronavirus, but they haven't taken action as a direct correlation to it.
Well, Brad, you know what happens with the Fed, and no matter what they tell you, they're looking at the stock market, and they always have. Unfortunately, that's not their job, but that's what they've been doing for the last 20 years, and they're still doing it, even under Powell. So you let us fall far enough, and they'll be in here. And we felt like all year that we would have some more dovish Fed. We were probably alone in that in a December projection, but we felt like that they would have to lower rates a couple of more times. And if you look at it now, where Fed funds are, it's almost impossible for them not to lower rates. And I know they're off talking about it and all that, but as usual, I've been at this a long time, they're late.
I must feel really good for you, Ted, right now to know that you are alone on the right side of history as we see it on the 27th of February. How much longer will you be in this holding pattern the way that you've been going now, given that you've been right so far?
Well, I think what would happen with us on it, Hope, is we look for situations where they get cheap enough to where we can buy a company. We really like to find companies. I think it's important for investors the next 5 years to buy companies that can weather all sorts of storms. By that, I mean maybe increase earnings at 12 to 15% a year, regardless of what atmosphere you're in. And I think that's what we'll be looking for in here. We're not big in fact, we own no cyclicals hardly at all. But that's the area we'll be concentrating on. I think there's places for people to do things. And I think they probably need to look at some yield. I know the yields have come down a lot so far, but if I were an investor and I had nothing but cash in my hands, there's no question that I would at least, at a minimum, lock down the 1 or 2 year treasury at this point.
All right, Ted, a lot of FOMO on this side. We can't invest at all, but it seems like you've had the right page all along. Ted Oakley is managing partner and founder at Oxbow Advisors. Thank you.